All right, I'm gonna get it this time. Got my suit on, ready to go. I'm off to work. I know I'm gonna get it this time. Gonna get that raise I've always wanted. Boss, I would like that raise.
No!
Oh. Welcome back to the Financial Forecaster. We're here to help make you rich. And that is going to start today by giving you a raise. Now in Canada and the US, depending on where you are, minimum wage isn't the best, yet that's how most of us are stuck at. It can range in Canada anywhere between $23,000 to $31,000 a year, assuming a 40-hour work week and 52 weeks of the year working. Let's go over what a standard raise is in Canada. Now, here at the Financial Forecaster, we always like to aim for conservative numbers. The more conservative you aim for, the more budget-friendly your numbers, the easier you are to outperform them. And I don't know about you, but getting a boost from outperforming my numbers helps me in the long run to always want to attain higher and higher. If you're setting a goal too high for yourself and you don't reach that goal, it can dissuade you from pushing harder. Now in Canada, a 1% raise can range anywhere from $300 to $500, and that's just a 1% raise. A lot of people struggle to make that every year. A lot of people struggle to even get that raise every year. Well, that's where investing comes in. When I first started saving money, I didn't have a lot in the bank. And I went to the bank and I asked for a TFSA thinking, I'll let the bank manage it, open up my tax-free savings account, put some money in, and let it go to work. And that is absolutely fine for most people. But I realized that my returns and my attention span towards what was happening with my money, it wasn't there until I started taking an active approach to it. And when I started taking an active approach to it, I realized that it was a lot easier than it seems. Dividend is, for each share you own, you are paid out a percentage of a company's profits. Easy as that. You own one share of something, that share is $100, you get 5% a year, you'll make $5 for each $100 you have invested a year. Not only do you make that 5% a year in dividends, but we can assume a 5% capital growth. With 5% capital growth on $100 is another $5. So if you think of it this way, every $100 you save, every $100 you responsibly invest, keyword being responsibly, you can hope to make an extra $10 a year. So let's break this down. We have 3 different kinds of dividend yields that you can look for. Anywhere between 3 to 5% dividend. So every portfolio investor needs to start with a defensive portfolio. And now this depends on your age, this depends on your position, and it depends on your experience level. But here at Financial Forecaster, we always recommend that your base portfolio be safe, solid in your biggest positions, especially when you're getting started. So let's go over 3 positions that are safe, reliable, and perform well even in market downturns. So our first play today, one of the most consistent and steady stocks in Canadian history, is Fortis. Fortis is a utility stock. We all need power, we all need energy, companies, homes, office buildings, regulated, the best income earner, the best dividend raiser in Canadian history, second to one of our other stocks that are coming up. It is a fantastic bet, not only for slow and consistent capital growth, but a nice juicy 3.6% dividend yield. For every $100 you invest in a year, every single time you take $100 and put it in, it will make you $3.06 a year. Now here we're talking about safety, we're talking about consistency, and next we're just going to jump to another utility, Canadian Utilities. Happily owned by the ATCO family of companies, Canadian Utilities is a long-time dividend payer. Funny enough, the longest dividend payer in Canadian history. 50 years plus this company has been raising its dividend every single year without cutting it, without leaving it stagnant, and slow and consistent capital growth. These are the companies that you want to put your money in if you want to slowly give yourself a raise every year. The last stock on our list, another safe bet. You want to always go for companies that people need, people want, consumer staples, telecommunications, utilities. These are what are going to base our portfolio in the safest, way possible. This is just when we're starting out. There's a lot of people out there that like aggressive growth, especially when you're younger. You want to more focus on growth companies. Rogers is one of the biggest telecommunication companies in Canada, along with Bell and TELUS. Now, we picked Rogers for this list because it's safe, it's reliable, pays a great dividend, and has nice, stable capital growth. Now, after all that, you get a dividend here, you get a dividend there. It starts to pour in. Every couple of months you get paid your dividend, which is lovely. But I'll tell you a secret. Just because in that first year you make about $30 in dividends, and you hold those exact same shares and you keep them for 10 years, well, this is where your future self will start to thank you. Dividends grow, especially with the companies that we were talking about. When you have telecommunications and when you have utilities, and you have companies that have slow, consistent growth and are paid no matter what kind of economic environment you're in, they will grow every year, especially with Canadian utilities and especially through Fortis. So the same shares that you buy 10 years in the future, they will be paying you more every year. Let me show you this with Fortis. Fortis tries to raise their dividend by over 6% a year. They have stated in the next 3 years that they expect it to grow by anywhere between 5 and 6% a year. Now, we're not investing in dividends for fast growth. We're investing in dividends for consistent growth. And as you can see here on this chart, the dividends get raised every year. Your yield on cost gets greater with every year. This is what you want to focus on. This is what you want to achieve. We are dividend growth investors here, at least at the beginning of your portfolio. Now, if you're young, if you're old, dividend investing is incredible. When you're in your 20s, if you start early, compound interest will be your best friend. If you're getting a little older like I am, I'm now in my 30s, dividend investing is a reliable stream of income and is less risky for your portfolio in your future because we don't have that many years left to be playing around with our money or risking it in something like Tesla or Shopify. Both great bets if you have the time and you have the temperament to run through them. But you know what? I like to sleep safely and I like to sleep soundly. So that is why we're focusing on Fortis, we're focusing on Rogers, we're focusing on Canadian utilities. These are stocks that will help us through the years, give us peace of mind, and will give us a raise every single year we hold them. Because investing shouldn't be scary. Investing should be a way to get ahead. And here at Financial Forecaster, let's get ahead together. Signing off. This is a disclaimer. This video is for entertainment purposes only. I am not a financial advisor.